Hi, I'm here today with Roger Conrad from the Capitalist Times, and we're going to talk a little bit about high-yielding stocks. What kind of stocks, high-yielding stocks, do you think people should consider to invest in?
Well, I think what you need to do if you're building a portfolio of high-yielding stocks, first of all, is think diversification, and also think that you don't have income without growth for very long. So what that argues for is a real a mix of things from a lot of different industries that are good, that are basically backed by good companies. So a good portfolio, I think, right now should include utilities, MLPs, a lot of energy, but also maybe some foreign currency stocks.
Sure.
Now, a lot of people don't realize, but if you buy a company based in Australia or Canada, your dividends are going to be paid in that currency, and both of those currencies, Canadian dollar, Australian dollar.
Are we talking ADRs or trading on a different exchange?
It really doesn't matter because you're still valued in that currency, and you're still getting paid dividends in that currency. If you buy an ADR, of course, the issuing bank is going to translate that into U.S. dollars, but the actual U.S. dollar value of that dividend will vary with the currency. So let's say we get more inflation in this country. Let's say we get the U.S. dollar going down. It's actually been going up the last or year or so against those two currencies. But let's say that happens. Stocks in those currencies are going to benefit by being priced in those currencies, which tend to keep up with.
Or the other way when the dollar goes down.
Right. Dollar goes down, you're going to get a nice bonus in these stocks, and again, it's a nice way to hedge yourself.
Why Canada and Australia?
Well, both of these countries are major producers of commodities, so their currencies tend to follow prices of commodities, tend to do better in inflationary environments, tend to do well when the dollar is declining. Conversely, they don't do well when investors are rushing to the dollar, as they did in 2008. As they did for a while last year when people were talking about the Fed tapering, raising rates, and so forth. But longer term, if you believe in, or if you want some kind of protection against the kind of debt levels that we've taken on in this country, you want to go to some more fiscally responsible countries that have currencies that are pegged to commodities that could benefit from more inflation. That's where you go. And you can buy productive assets, which is basically companies that are growing their business, and energy business is one place to look.
Are there a couple of names that you like right now?
Well, I really like Brookfield Renewable Energy Partners, and the symbol of that is BEP, and it trades New York, but again, it's a Canadian company. It's the world's largest
regular New York Stock Exchange stock, not an ADR.
Regular New York Stock Exchange stock. Of course, they have a dual listing in Canada as well.
Sure.
And they have hydro plants in the U.S., Canada, Brazil, and now Ireland. So they basically build plants, buy plants, it adds to cash flow, they raise their dividends. They yield around a little over 5%. They've been growing their dividend pretty close to 7%. So nice combination, particularly in a currency that is somewhat protected against inflation.
Thank you, Roger.
Thank you.
Thanks for joining us at MoneyShow.com.